So on the asset side, we get asked this question by investors often. Why is Solana suitable for a treasury asset? And the answer, I think there's three of them. One is Solana is more volatile than Bitcoin, and ultimately, volatility facilitates fundraising and the kind of flywheel in the NAV Premium. And the reason that is because convertible debt is priced off of volatility, because investors look at the convertible debt offerings as like a way to purchase a low-cost option. And options, of course, are priced heavily. The equation to calculate value of an option is based on volatility. So the more volatile the asset is, the potentially lower cost of capital for these businesses.
All right, here we are with Joseph Onorati, CEO of DeFi Dev, the second largest Solana treasury company. Joseph, it's great to have you on the Defiant Podcast. Welcome.
Well, thank you for having me. I really appreciate being here.
Of course. So crypto treasury companies have really been all the rage recently, with Bitcoin being first with MicroStrategy, Ethereum, and now Solana really picking up steam as well. And DeFi Dev is the second largest of these companies, like I mentioned. With recently, I think the most recent numbers I have is $380 million in dollars in Solana holdings. And that's pretty close to the largest Solana treasury company, Upexi. Between those two companies, you really make up the largest amount of just Solana held in treasury companies. So if we can just start by like the basics of DeFi Dev. When did you launch this? Like, what was its kind of previous incarnation? Like many of these companies are you take over from like other previous companies to make these crypto companies. So like a bit of the backstory of DeFi Dev.
Yeah, sure. Thank you. So DeFi Development Corp, DFDV, is the company and the ticker, and we are the first non-Bitcoin treasury company listed in the U.S. And we chose Solana as our treasury asset. We did a change of control transaction back in April with a business that was previously named Janover, old ticker JNVR. And to do that transaction, we basically the management team and I, who's a former Kraken team that we've put together, we're all out of Kraken, the cryptocurrency exchange. And we just bought over half the stock of the company and have retained the current team or the historic team, the legacy business, and we've pivoted the treasury strategy of the company to hold and acquire SOL, the Solana token. And we have also brought into that business Validators, run by kind of my co-founder, the COO and CIO at DeFi Development Corp, Parker White. We brought in his validators, and now we run a Solana validator business. So we stake the balance sheet assets that can be staked to our own validators. We'll probably get into that more in a bit. So we earn the native yield on Solana plus the validator block rewards on the balance sheet assets. And we have done 4 fundraisings now, and we just announced our most recent one on Monday for $125 million in a straight equity deal. And we intend to use nearly all of the fundraised amounts from this and all previous fundraising to acquire more SOL tokens and stake them to our validator. We also have a liquid staked token, DFDV SOL, and LST. That's a single validator LST that Sanctum, which is a Solana project, has helped us set up. And we deploy about 10% of our balance sheet assets into DFDV Sol. And DFDV Sol is a collateral asset for, you can borrow against it essentially in Solana DeFi. So it's integrated in Camino, Drift, Radex, Exponent, and a number of other Solana DeFi projects. And that lets us run a stake looping strategy that can drive additional yield to the balance sheet for the company. So maybe to sort of cut this shorter, we have a number of ways that we earn yield on the balance sheet assets, and the primary metric for the company is Solana per share growth.
So can you break down a bit further how your strategy works? So you hold Sol in your treasury. How much of that is staked? And then you said 10% of your Solana goes to buy your liquid staking token, and then that goes into Solana in DeFi, or what's kind of the breakdown?
Yeah, so I'd say all, or very practically all, of the Solana held on the balance sheet is staked, and that's broken down in a few ways. So we buy there's this locked Sol that exists, and it's all custodied with BitGo. It came out of the FTX and Alameda bankruptcies, where they had purchased this discounted locked Sol from the foundation years ago, the Solana Foundation years ago. Alameda had primarily purchased it. And then in the bankruptcy, the keys for that locked Sol was sold off, and you can still buy it OTC. So because we're essentially permanent holders of the Solana, we can bring in some long duration assets onto the balance sheet. And this, of course, fits our strategy. So we're able to buy at a discount to the spot price on a lot of these assets, and they are staked to a particular set of validators that's like a contractually arranged. And our validator is not in that set, but those assets are still staked. Then whatever liquid Solana we hold, we stake it to our own validator. And then, as I mentioned with the LST, we don't actually buy the LST, we mint it when we stake to DFDV Sol. It is minted when we stake to our validator, single validator LST. So anyone who mints DFDV Sol could be or is staking to our validator as well. And then, I think I got your question, but let me know if I missed something.
Yeah, no, and then you use that DFDV in DeFi and Solana to earn additional yield.
Yeah, so the strategy there is, and anybody can do this. It's this particular part of the strategy can be replicated by just yield farmers out in DeFi. So to borrow liquid Sol, you can borrow with, I don't know, say 6.5 to 7.5% interest to borrow on, say, Camino or Drift, and our validator earns, I guess if you staked to a third-party validator, like a low or zero-fee third-party validator, you would earn approximately that amount, around 7%. But if you run the validator yourself, you accrue the block rewards, which is about another 1%. It's how typically how the validators kind of make money from third-party delegation. So and we can kind of collect that ourselves because we're running our own validator. So we mint the LST, which continues to earn the underlying yield. Then we deposit it to Camino or Drift or another lending platform as a collateral asset, where it continues to earn yield for us while it's acting as collateral. Then we borrow Sol at, call it 7%. And we stake that Sol to our validator, or we mint additional DFDV Sol with it and earn, say, 8. So, and you can lever this strategy up, loop it. So I think our all-in yield on a single Sol contributed to the strategy, say, is a little over 12%. But like I said, anybody can run this strategy, and the kind of DeFi yield farmers are out there in full swing running similar ones. Yeah.
What's the risk you take in this looping strategy?
Yeah. Well, there's no, importantly, I think critically, there is no price risk because we're using Sol to borrow Sol. So, if the price draw down 80% or something, right, we can't get liquidated because it's a Sol on Sol loan. So that kind of gives us comfort, but there's the smart contract risk, and there's kind of layers of it. So there's the LST smart contract risk, then the lending platform smart contract risk, and then there could be another step or two added to the strategy that could add additional layers. But all these contracts have been audited multiple times, and Camino, for example, has over $3 billion in TVL, and no major security incident, and the LST contract itself is the same contract used across all LSTs in Solana.
Okay, so it's a 12% yield on Solana.
That's right. For that 10% of the balance sheet, I think our all-in yield across the whole business, I think we put this in our quarterly filing, is right around 10%.
So can you talk more broadly about the case for DATs or for these crypto treasury companies that have really taken off? Like why not just own Sol in your case directly and just a yield farm or stake? Like what's the case for buying an equity?
Yeah. Well, I think MicroStrategy or strategy now is probably kind of the easiest example to talk about this, and then I can kind of compare DFDV to MicroStrategy. So last year, MicroStrategy yielded about 70%. I think it's 71% Bitcoin per share growth. So you pay a premium to the Bitcoin to buy MicroStrategy stock, but how much is this, at least looking back anyway, the 70% yield on the Bitcoin worth, right? Like maybe that's worth 2 or 3x the current price of Bitcoin if you could project that yield forward. And that yield on Bitcoin, of course, you can't earn. There are ways to earn native yield or almost native yield on Bitcoin, with something like Babylon restaking, say. But MicroStrategy is earning this through essentially financial engineering. They issue convertible debt at a premium to the stock price. They are able to run their ATM, the at-the-market new share issuance program, at a premium to their net asset value, and then they basically turn $1 into $2 with the ATM, or that's one way of looking at it. And of course, they're issuing I think 4 series of preferred stock now as well, and as one series is convertible into the common stock. But if the preferred's not convertible, then it's purely accretive on a, say, Bitcoin per share basis or Bitcoin yield for the common shareholders of MicroStrategy. And this is kind of the foundation for the digital asset treasury companies, right? They're all looking at what MicroStrategy's done and saying, oh, if our stock trades at a premium to our net asset value, then essentially dilution is accretive to shareholders on a crypto asset per share basis. And DFDV, as I mentioned, our key metric is Solana per share growth, SPS growth. And it's the same idea. MicroStrategy's like inverted this to talk about Bitcoin yield, but they're more or less the same metric. So the advantage, I suppose, for owning a digital asset treasury company stock over owning the underlying stock is essentially if the investor thinks that the DAT can grow the asset per share kind of faster than the investor might be able to earn yield on the underlying asset themselves, then it's a good trade to invest in the debt. And these vehicles are very powerful, I would say. So we put out guidance on our SOL per share growth. I think it was probably about a month ago, maybe it was 6 weeks ago now. And we projected forward 261% annual growth in SOL per share. And I said, geez, how are we going to do that? I mean, that before we put it out, right? And we're modeling this. And I say, I actually think we can hit that. And it's possible because, again, essentially, if the Treasury vehicle trades at a premium to its net asset value and it can raise money at the premium, it can just use the proceeds of that fundraise to buy more of the underlying asset. And this is essentially kind of the primary flywheel, I would say, for growth of these Treasury vehicles.
Yeah. Yeah, so it's essentially trusting the management of these companies to be better at investing these cryptocurrencies than the individual holder. Kind of like a hedge fund of sorts, but like wrapped in these like equity vehicles. But it really does depend on what you mentioned on the net asset value being higher, there being a premium, right? And we've seen that some kind of red flags on that front with NAVs compressing across all crypto treasury companies, Bitcoin, Ethereum, and Solana as well. Why do you think this is happening? And yeah, are you worried that this trend might continue?
Yeah, okay. Well, why are we seeing this happen? So, back in the day, I studied economics, and I think it's just supply and demand. I don't know, 5 months ago, before we came out, right, there were none of these, and there was probably demand for them. There was clearly demand when we were able to fundraise at a meaningful premium to NAV, and I've seen some of the other companies also trade at a meaningful premium. But once these companies are out in market and there's an increasing number of them and they're more aggressively kind of attempting to fundraise, we should expect that the premiums compress over time. And we actually charted this out. I think it's in one of the DeFi Dev Corp kind of official Twitter, like longer posts. I think we called it something like the death of crypto treasury vehicles. That's kind of a clickbait headline. But if you chart this over time, just over the last 6 months, there's this huge variance in NAV when this kind of phenomenon sort of started to take off for at least the non-Bitcoin treasuries, but also for the treasuries. Of course, MicroStrategy was there. And those NAVs have come in and they've also converged. And of course, they haven't reached one yet, but that's definitely happened. And I think, again, it's supply and demand. There's, more supply. And then I think another component is the market just doesn't know how to value these vehicles yet, right? Like I've heard of, or spoken to our investors are saying, well, we just split our allocation across, 4 vehicles because we're not sure which one is kind of going to be the winner. And I think in the longer run, there should be kind of a clearer differentiation between these businesses, which is why we focused on the on-chain yield generation and running our own validator infrastructure, because we think, ultimately, or in the longer run, that will be how we can kind of sort ourselves from some of the other treasury vehicles that don't actually participate in their assets ecosystem and earn lower native yields than we do.
So where do you think is the absolute lowest that a NAV premium can go before it starts to get difficult for crypto treasury companies?
Well, I don't know about get difficult, but I think these, maybe I'll take a guess in a little different direction. I think some of these companies will trade under 1x NAV, and some of them already are. And when they trade below 1, it's essentially impossible to fundraise, or if they do fundraise, it's not accretive on a crypto asset per share basis for the investors. So I think it's certainly not in shareholder interest for them to fundraise at those levels. So does that make it difficult or more challenging? Well, MicroStrategy traded below 1x in the last bear market. Was that a problem? Or it's like, yes, I'd say it was a problem and a challenge, but Saylor was out there kind of beating the Bitcoin drum kind of throughout the cycle. And I think that gave them and MicroStrategy a lot of credibility. We know they've weathered a bear market now, and they didn't quit and they marketed through it, and now they're a $100 billion business.
So under 1x is challenging but not impossible to overcome, basically.
Well, in order for the business model to work, the companies at least some point have to trade
at
over
1
1x.
at least.
Yeah, at over 1, because otherwise, the fundraising kind of flywheel doesn't work. Right? You can't fundraise and buy more of the underlying asset than you issued in shares. So there is no crypto asset per share growth possible from additional fundraising at below 1x. But there will be things that these companies can do otherwise, right, that could generate revenue that they could use to grow their balance sheets.
Does running your own validator make that pressure, increase that pressure for you, because you're running kind of additional costs beyond just like holding an asset and like putting it to work? You also have like the hardware or whatever, like the cost of running the validator.
Yeah, well, I'd say it's actually the opposite. I think running the validator makes it easier. So if DFDV say traded under 1x NAV, maybe kind of in the bottom of the bear market, I'd say, well, we're still earning whatever percentage yield we're earning at the time, right? And we still have a validator business. We still get a third-party delegation to the validator to generate additional revenue and to grow our SOL balance sheet, and therefore SOL per share growth.
That makes sense. I'd love to get your perspective on like how these different DAT companies differentiate. There's Bitcoin that doesn't have native yield, Ethereum that does, and Solana that does. How do these kind of three types of treasury companies differentiate?
Yeah. Well, I think there's ultimately two. I guess I sort these into two categories. One is like, how do these companies differentiate? I guess is what I'm trying to answer. There's two ways to sort it. One is who the team is, and the other is what's the asset. And those are kind of the broad buckets, and then kind of everything falls into something under that, I think. So, or and maybe they're related. So on the asset side, we get asked this question by investors often. Why is Solana suitable for a treasury asset? And the answer, I think there's three of them. One is Solana is more volatile than Bitcoin, and ultimately volatility facilitates fundraising and the kind of flywheel in the NAV premium. And the reason that is because convertible debt is priced off of volatility, because investors look at the convertible debt offerings as like a way to purchase a low-cost option. And options, of course, are priced heavily. The equation to calculate value of an option is based on volatility. So the more volatile the asset is, the potentially lower cost of capital for these businesses. Also, because of the way the the tools for the fundraising happen, like the ATM, the at the market new share issuance to issue new stock and sell it into the market. They're based on how much volume the stock trades, and volatility and volume are correlated with each other. So you need a volatile underlying asset. Like it would be very hard to do a stablecoin treasury strategy company, for example. So that's one. Solana is significantly more volatile than Bitcoin. Two is there's native yield on Solana, so you can stake it and earn yield. You can run a validator and earn yield. And three is the treasury companies can participate in their own ecosystem to generate additional yield. And I guess I call it create our own destiny. So we can put our own balance sheet assets to work. We can grow TVL on Solana. We can make it cheaper for others to borrow on Solana, and hopefully facilitate growth in Solana adoption as a result of our participation. Those are kind of the key differences between the Bitcoin treasuries and the Solana treasuries. And of course, much of this also applies to Ethereum. Ethereum is also more volatile than Bitcoin. There is native yield on ETH. And these companies can, however, I don't think anyone is yet participating in the Ethereum ecosystem to drive additional yield to their balance sheet assets.
So it's interesting that with all that considered, the assets in Solana treasury companies are a lot smaller versus the market cap of Sol compared to the same metric for Bitcoin and Ethereum.
Yeah.
So I ran kind of this, and so around 6% of Bitcoin market cap is in Bitcoin treasuries. That's 4% for Ethereum, but for Solana, it's only 0.8%. So why do you think that is?
I'd like to take some credit for this. I think a lot of the companies that have come into this space and the management teams that have come in since we did our transaction in April are I'd say opportunistic, and they didn't say, okay, well, we are really committed to this asset and we want to do a treasury company. That's what we did. Just Parker, who I mentioned earlier, I think I mentioned him earlier, who's COO and CIO at DeFi Dev Corp. When we got together back in January to start talking about this venture, we just knew we were going to work on Solana because we're bullish on it and think it's going to flip Ethereum by market cap, and the user experience is totally superior. And we'd been involved participating in Solana DeFi since mid-21. We actually had commitment to the asset, and so I think a number of these other teams coming in are saying, well, I want to do a DAT. What asset should I look at, instead of saying I want to do something in Solana and we can do something here in the public markets. And so I think kind of a competitive dynamic sort of pushed some of these treasury company managers or teams to work on other assets first, because Sol Strategies in Canada already existed. Prior, I think they started their treasury strategy back in, I want to say September, maybe December. And then we picked Solana and came out there. Upexi was shortly out doing a Solana treasury strategy after. And we kind of led the way in this, but with relatively smaller capital raises than we've seen since for some of the other assets. But I suspect that, of course, there's more fundraising kind of in the pipeline for the Solana treasuries, and likely new entrants coming to market also looking to fundraise larger amounts. So I think this is kind of a temporary thing. It's kind of competition based, and some of it's again because the teams and companies that have come in are saying, well, there's already a couple of companies doing this on Solana. Let me go look at another asset. Maybe I can run faster with that other asset. which, of course, we didn't think about it that way.
The PR Genius is a top crypto PR and growth marketing agency, helping brands globally with expert PR and strategic growth marketing. They've worked with 300 plus projects like Movement Labs and IO.net. Unlike traditional agencies, they charge only on performance. Their services include earned PR opportunities and marketing services to help boost wallet holders and organic X followers. Learn more at www.theprgenius.com.
To me, it was interesting to look at this at these metrics, because I would have thought that Bitcoin and ETH have their ETFs. So, that adds competition or it adds more choice for investors, especially for institutions who are, thinking about how to get exposure to these assets. They have treasury companies and they also have ETFs, but that's not the case for Solana, at least not in the US. So it was just curious to me. Solana doesn't have an ETF, so to me it would make more sense that institutions would use treasury companies as a vehicle. How do you think having ETFs will impact demand for you?
Yeah, I guess I have a few thoughts on this. So one is the relationship between the DATs and the ETFs, I think, is probably more complicated. It's not, I don't think it's a competitive thing. Like when in our last two kind of fundraisings, and when we're talking to the, traditional hedge funds and asset kind of managers or allocators, some of them want long-term directional exposure to Solana, but many of them have some kind of angle they want to trade on these assets. So, for example, they might want to trade the NAV premiums of the treasury companies, but to trade and some of these same funds that might want to trade off the NAV premiums for the DATs only trade traditional markets, like they don't trade crypto. So they can't say long DFDV, short Sol to bet on movement in the NAV multiple, right? That's not a trade that's available to them. But if there was a liquid Solana ETF market, they could. That's just one kind of example strategy, right? There might be others with options, say, and of course the other direction on the trade as well, to bet on NAV compression. And I think Ethereum and Bitcoin are benefiting, or the Ethereum and Bitcoin DATs are benefiting from the existence and the liquidity in the ETFs, because it enables these trading strategies, which again drives liquidity and potentially volatility to those stocks, which in turn enables fundraising for these businesses. Again, because you have to have meaningful volume traded in the stock, because basically when you run the ATM to issue new shares and sell it into the market, you target a percentage of daily volume, or that's like one of the ways to look at it as a way to fundraise. And we've seen where the Ethereum vehicles have raised, say, $1 billion in a week. And this is only possible, or it's made possible, by the amount of volume traded on their instruments, which, again, I'll tie it back in, is facilitated by the existence of the ETFs. So somebody at the Solana Foundation asked me, a month or so ago, what I think of the ETFs coming. And at the time, I didn't kind of fully understand the level of tie-in between these kind of financial products, the DATs and the ETFs. I'd say I just was missing it. But as I've talked to more investors, I've kind of come along on this, said, well, I don't know how big of a deal the ETFs are going to be. It can't be that hard to buy Sol. But I think I was just looking at it I'd say, a very wrong way, and it's much more complicated than I had initially thought it was after spending more time with investors. Now, okay, and maybe this is taking me a while, but on my other point here, I think the total addressable market for public market demand for exposure to crypto assets is much bigger than what we've encountered so far. And, of course, we see increasing demand for MicroStrategy preferreds every time they issue a new preferred offering. The IPO is bigger, the ATM that they can put on it is larger than the previous, and I think we're going to kind of see all kinds of financial products spring up around crypto in the public markets, not just preferreds or convertible debt or the DATs, but more. And there's going to be a lot of innovation, I think, brought on by the DATs in this regard. I think we'll see crypto-denominated instruments right around the corner as well. I might be a little carried away on this one.
Super interesting. Yeah, I hadn't thought of ETFs enabling more trading strategies with DATs and actually, increasing the potential market for DATs rather than taking away from it. Super interesting stuff. So you said, there's a potentially bigger market for, or you see more demand for public market instruments with exposure to crypto. How big do you think that is? I don't know if it's like as a percentage of crypto market cap or as an absolute number, however you're looking at it.
Oh, yeah, I don't know if I've modeled a number for this, but over the next 10 years, I'd measure it in trillions.
And again, like as a percentage of crypto market cap, how do you think that?
Over 100%.
Really?
Mm-hmm.
How? Because there will be like
all the prices are going to go up.
So you think that like crypto in like public market instruments will surpass total market? Like how?
No, sorry. I mean, like let's say if the market, total market cap of crypto is, I don't know, let's call it $4 trillion.
Yeah.
10 years from now, maybe it's like $40 trillion.
Mm-hmm.
And then public markets might be, I don't know, 20 or 30% of it.
Oh, okay.
And I just made up those numbers, but it gets my point across. Yeah.
And you said you're looking at a lot of potential innovation happening here. I'm interested to hear what you think that might be.
Yeah, well, let me give a nice cop-out answer on that one. I think we've seen some of this already with the evolution of the MicroStrategy preferred offerings, where the preferreds are essentially, debt in one way or the other, where each one is kind of trying to approach a different part of like the asset allocation mix, I would say. So the first one was a convertible preferred that looks kind of like a convertible debt instrument and might be appealing to convertible arbitrage funds, say. Maybe the strike was too far out of the money for it to be very appealing, but as MicroStrategy stock approaches $1,000, I think it gets very interesting. And then the most recent one is essentially a variable rate offering, and it looks like a very high yield money market. And Bitcoin-backed money markets here. So I guess those are examples of what we've already seen in the market, but I think there will be crypto-denominated ones, for one. Like maybe we'd see a Solana-denominated preferred offering or a Solana-denominated convertible debt instrument. And I think we'll see the same, for Bitcoin and Ethereum and other assets. And how can I put this? I'd say there's many smart people thinking about how to appeal to a broader investor base with the creation of additional financial instruments. And it's actually not that hard to like create one of these things in the U.S. public markets. To issue preferred debt with different terms. I mean, you just write a term sheet and you talk to your attorneys and you find an investment bank who will help you sell it. It's possible to turn these around in a few weeks. And same for the preferred stock offerings. The larger issuers and a bank can, and the right attorneys can turn around a new preferred offering in certainly less than 2 months, and just create a new financial product that maybe gives investors exposure to some aspect of cryptocurrency that maybe they would have a lot of trouble getting exposure to otherwise.
Mm-hmm. So what are you envisioning? Just like, for example, like more sophisticated DeFi strategies offered in these vehicles or things like that?
Yeah, that's definitely one of the possibilities. Yeah, one that we kind of contemplated before we went with the Solana strategy, for example, was a stablecoin yield one, where we would raise money in the U.S. public markets, and then we would essentially, tranche that debt up, or the cash into stable coins, where one earns like a base fixed yield, and the other earns, the riskier one facilitates the yield on the kind of forget what the word is, like the safe debt, and the other is like a variable rate higher risk debt, but the potential returns on it could be very high. And the numbers look pretty good for this. It's not that hard to earn maybe 10% on stables in DeFi, and you tranche this up. Maybe one earns 8 and the other earns, between 0 and 24% or something. It becomes very interesting financial assets.
Very cool. With all these different instruments coming, there's always the increased risk coming together with that. It does start to sound very much like, or rhyme with like previous issues we've had with rehypothecation and just like lack of clarity on what the underlying is and how these stocks are being issued. So how can we prevent going kind of down that same path?
Yeah, well, I have spent a lot of time thinking about how this can unwind and, whether it will, right? And of course, I've worked in crypto markets since 2013 and at exchanges primarily. And, the exchanges kind of are frontline in the action of, a bear market, right?
Mm-hmm.
So, there's a kind of mass hiring and incredible difficulty keeping up with demand on the runs up. And then on the other side, you're, okay, well, how are we going to manage our balance sheet on the way down? And are there layoffs and so on? I've been through a lot of these cycles now. So, and the whole team at DFDV has been through a number of these. So we spend a lot of time thinking about this. And I think I guess there's kind of two interesting points for DATs that I've kind of seen in, crypto Twitter that are concern areas. One is the DATs are going to sell at the bottom and, blow up the market. And the other is, we're going to have like a FTX-like situation after this. Maybe I'll address the FTX-like one. So in the kind of FTX cycle, there was all these businesses were lending to each other. And many of these loans ended up being uncollateralized, right? Like Three Arrows Capital to whoever else. And it's like this chain reaction of companies blowing up and pulling the markets down with them, and the FTT, as collateral and pricing issues. I don't think that we're going to see this sort of contagion for DATs because they're not lending to each other. if we get to a point where, we're at like the height of the bull market and somehow these companies are lending to each other and have like interlinked themselves, then okay, yeah, that sounds risky. But that's not happening now. There's none of that. So I'm not very concerned on the contagion side. The other that I frequently see, these companies are going to sell at the bottom. I actually am not convinced that these businesses, the vast majority of them, are going to ever sell their balance sheet assets, because I think that it's just not in the incentives of the management team are not to sell these assets, because so the situation that would lead to selling the balance sheet asset would be the company trades it under 1x NAV, and then they say, okay, well, it's like immediately accretive to shareholders if we sell the balance sheet asset and buy the stock, and we bid the stock back up to 1x. So like a no-brainer, right? Or this is the theory. But and I think some companies will do that, but I think this is a death spiral for DATs, because why would the company trade it below 1x in the first place? Well, the market must think that the management team's doing something wrong here, right? So I don't know why that would change from like 1 week to the next week, right? So, we're 20% below our net asset value. Let's sell some of our assets, buy the stock. Well, the next week the market looks at the stock again and says, well, the management team's still doing a bad job. Let's bid it down again. And these companies are going to end up like deleting themselves essentially if they start that spiral. So yeah, there's going to be like a fad or trend of, we're announcing that we've turned on a buyback program, or we've set ourselves up to have a stock buyback program. But if there are buyback programs, I think almost all of the funding for the buyback program will not come from selling the balance sheet asset. It'll come from, some other revenue source. And another thing that's interesting about public markets and these treasury companies is these companies can actually have a lot of influence on their own stock price within kind of some bounds. So we already talked about the ATM, where companies can issue stock and sell it into the market. So they can kind of put a ceiling on their own NAV multiple if they wanted to. And then on the buyback side, they could basically just trade this in a window, right? And like, we're not doing this, but it's possible. So maybe a company would come out and say, we're going to set some cash aside. If we trade below 0.8, we're going to buy it back up with cash, not with our treasury asset. And if we trade above, I think MicroStrategy put out guidance on their, when they'd run their ATM, right? If we're at, 3x, we'll run the ATM. And then the company is basically like locked in this range. And the company almost has, they don't have like total control over it, but they have a lot of control to stay in that band.
I think it's easier to compress the NAV than to raise it. Like if, you said, if like the market lost confidence, then yeah, you can have a buyback program, but it'll just keep going below NAV.
I totally agree.
Yeah, but I there's definitely risk there. But there's something else I wanted to ask you, kind of related. I don't know if you saw this recent controversy with Soldats, that some people were alleging that it was basically a vehicle for VCs to dump their staked SOL. So they like investors are investing their staked Solana in these, I guess, like would be OTC deals.
Yeah, I think you're referring to the locked SOL deals. Yeah. Okay. Sorry, go ahead.
Yeah, and so having these kind of backdoor deals with the Solana DAT companies that essentially enables them to get stock in exchange for their locked SOL, and then sell that and get instant liquidity. Have you seen that happening? Or what's exactly going on here?
Yeah, sure. I can lay that out. So I mentioned the locked SOL at the beginning of the conversation here. So I think the origin story on this was years ago, maybe in 22, 21, a while ago now. The foundation was selling like locked sol that has some vesting schedule associated with it, and Alameda bought a lot of it. And then, of course, Alameda went bankrupt or blew up, and the locked sol was sold off. And this locked sol still exists, and it's still on like these vesting schedules. So it unlocks.
Sorry, it's logged where exactly?
Well, BitGo is the custodian for all of it.
Ah, okay.
So BitGo holds this locked sol. It vests monthly. You can stake it. It can only be staked to like a set of 5 validators that can be, chosen in like a BitGo interface if it's custody at BitGo. Some of it's also rolled into a fund structure that Galaxy created, and then they stake to Galaxy's validator. And the weighted average like remaining duration on this locked sol is about 1.3 years. Again, vesting monthly. The final like vest or unlock date is January 2028, and you can trade it OTC. So the BitGo OTC desk facilitates trades for it. Galaxy facilitates trades for it. A number of other desks can facilitate trades for these assets. And I guess you could buy it in any like block size. Maybe the Galaxy one has like a size constraint where you have to certify that you're like a institutional buyer or something. But anyway, it's available, to individuals as far as I know to trade it. But the block sizes are typically larger, so you'd have to be like rich or an institution essentially to sort of be able to get access to this flow, I think. So DFDV participates in these markets. We buy a lot of the stuff, and we think it's accretive to our shareholders for us to do that because we can see discounts say between 11% back from spot to maybe 15.5% back from spot on the sol. And again, since we're extremely long, probably infinity time duration holders of Solana, we don't care if it's locked or not because we're never going to sell it anyway. So it makes a lot of sense from our perspective to buy the stuff. Now, is that a problem or a way for VCs to like unload their bags on retail or something here? I guess I don't really get the argument. We've been transparent. It's like we post when we press release, we say we bought locked sol or we're holding locked sol. We're never going to sell this stuff. Doesn't matter if it's locked. And so then investors make an informed choice about whether they want to invest in the stock or not, and whether the sol is locked or not. And of course, it does vest out into liquid sol monthly as well. Now, I think there are probably some other sol vehicles coming to market that will have larger contributions of potentially locked sol. But I think as long as investors know, they get to, make their own choice about, what vehicle they want to invest in and their exposure to liquid or locked sol inside their, DAT of choice.
Yeah. So the origin of this locked sol is VCs investing in Solana via the Solana Foundation, or?
Yeah. I wasn't paying much attention back then to, Solana Foundation selling assets into, whoever might be buying them. But yeah, they used to sell like a locked sol as a method of fundraising. And I think that at the time, and maybe even now, it's like community aligned, right? Like they want to raise money to drive the ecosystem forward. And they, you know, of course, foundations have to sell their tokens over time. That's just how they work. To raise capital to pay whatever their expenses are, you know, sponsor hackathons, security, marketing, whatever they happen to be working on, legal, and research. And yeah, made a lot of sense to me for them to do that. Though, you know, I think, of course, at the time, nobody knew Alameda was going to blow up.
Right. And now, basically, this Loxo is being traded OTC, and you're one of the buyers there.
Yeah, that's right.
Yeah, that makes sense. I guess, like, but then, like, you can't, can you still issue LSTs against it?
No, not against the locked sol. So, like a 10% approximately of our balance sheet is deployed on chain, as I mentioned. That's not coming out of the locked sol. The only thing that we can do with it is stake it. And well, some institutions in the crypto space will also accept it as collateral. So one could borrow against it or you know, trade with that as a collateral asset.
Okay, makes sense. Okay, and then to start wrapping up the conversation, I'd love to hear your bull case for Solana. Like, what made you pick this asset?
Yeah, well, I don't know if this is the very technical answer. It's not a very technical answer, but I remember, so I was a pretty serious Ethereum user for a long time. And, you know, I was kind of used to how poor the bridging experience is, or how, I don't know, dealing with a layer 2 or fragmented liquidity, et cetera. So I kind of had these like expectations of like, this is what it's going to be like to, you know, participate on chain. And then when I first started participating on chain with Solana, I'm like, this is like a Web 2 application. Like, how is this thing so fast? And the strategies that are enabled and the applications that are enabled by a chain that is so fast it feels like a Web 2 application kind of blew me away. I'm like, wow, you know, this is 100x better, you know, user experience. So, I mean, that's kind of the start of my bull case. Honestly, it's about the user experience, and you know, of course, the metrics supported, and we have if you look at the DeFi Development Corp Twitter, we're always posting these like metrics on Solana, essentially comparing them to other chains. And you know, one of our new ones I think we just put out is capital efficiency on Solana, like how often TVL turns over from like being allocated to a trading strategy on Solana, for example, and that's an outcome of the speed of the chain, ultimately. And then I think Solana's there's been more wallets created on Solana than all chains combined this year. There's more trading volume on Solana than all chains combined this year. I mean, many of these metrics, right? It's the winning chain. And I think it all kind of ultimately came down to the user experience advantage.
What do you think about like the most common criticisms of Solana, their past downtime, and it being more centralized because, you know, like higher requirements or you know, a higher barrier to entry to become a validator?
Yeah. So the first one was the barrier to entry, or second was barrier to entry to validator, and the first one was what?
Downtime.
Downtime. Oh yeah. So while the chain hasn't gone down in 18 months now, and I actually think of this as sort of a selling point. I mean, sounds a little backwards, but so with Bitcoin, it's a store of value, and hopefully it's money. And we probably never want any downtime on Bitcoin. We don't want it to change much at all, if ever. But Solana is a tech platform, and that tech platform has to improve, and it has to improve rapidly. Like, this is a race against, say, Web 2 systems and other blockchains, other smart contract blockchains, and it's a technical race. And this technology is what enables the user experience and facilitates the mass user adoption. And I'd say downtime is actually a sign that the ecosystem is willing to move fast and take some risks to continue to innovate. So, if there was never downtime on Solana, that probably means they're not innovating fast enough, and a chain that might be willing to have, downtime once every 2 years could win on the technology side. And ultimately, it's a technology race. I mean, Solana can't stop improving, right? Like Bitcoin can and probably should calcify and say, okay, the base chain for Bitcoin is perfect, it's done. But Solana must continue to innovate, and it must out-innovate its competitors. And then on the validator centralization thing, I think Mert tweeted this, and it kind of hit me. Blockchains become more decentralized over time. And I was like, whoa, how does that happen? And I think this probably only applies to active ecosystems with kind of further development. But I think there's 1,400 active validators now on the Solana ecosystem and Solana blockchain. And if I just read Twitter, it's like, oh, it's centralized, there's only a few validators, I'm thinking Hyperliquid or something, right? There's 16 or something. And no, that's just not the case. Go look at the metrics. There's 1,400 of them. And this has increased over time. And I think the hardware requirements aren't intensive. I mean, we rent the server space or whatever for running our validators. We don't actually own the hardware, we rent it, and it's just not that expensive. I think it costs us less than $600 a month to run the validators, or we're going to run one validator. And it's a barrier to entry, but the vote costs are a bigger barrier. But there's already 1,400 validators. Sure, maybe there could be more decentralization among assets allocated to those validators, but I think that's already globally distributed and decentralized enough. And kind of, if you apply the blockchains become more decentralized over time sort of thinking, you say, okay, yeah, there's probably going to be more validators over time. The assets are going to be more widely distributed to more individuals over time. There's probably going to be more validator clients over time. It depends on how you want to measure decentralization, but I'd say if the ecosystem is active, and particularly if it's growing, then this holds. We can call it Mert's law.
Nice. You said you think that Solana will flip Ethereum. When do you think this will happen?
I'd say my bull case is this cycle, if the cycle lasts long enough. Yeah.
Wow.
Yeah. I'm pretty bullish.
And I don't know, I would just love to hear kind of more on this, Solana flipping Ethereum. Where do you think that growth will come from?
I think we're already on the trajectory there, right? It's the user counts, the wallets created, the transaction count. I mean,
but is it like more retail DeFi trading?
Yeah. Well, okay. It doesn't have to necessarily be DeFi. So I'm we're pretty focused. I'd say very focused on DeFi, and that's why we named the company DeFi Development Corp. And I think DeFi is the money is the best application for blockchain technology, but finance is the second best and probably an even larger application for blockchain technology. But the adoption doesn't necessarily have to come via DeFi. It just happens to be like my area of kind of interest. But it could be gaming, could be art, could be I don't know, RWAs outside of finance even. So I'd say a variety of sources, and Solana's adopted to facilitate all of these use cases at scale.
Cool. And then to wrap up, what's next for DeFi Dev? Like, what are you building? Like, what are your next milestones?
Yeah, thank you. Yeah, the thing that we're spending a lot of time now on is what we're calling DFDV Treasury Accelerator. And the Treasury Accelerator is a program where we facilitate the launch of other DATs in other geographies focused on Solana. So, for example, maybe we look at, Metaplanet's been very successful in Japan. It trades a meaningful NAV premium, and there's kind of structural differences in that market that drive local investors to want to invest in a local company. It could be major tax advantages, could even be capital controls, or it could be cultural. And we put out this press release, probably been 6 weeks, 8 weeks out from when we put that out. That was to kind of garner inbound interest on this, and it's been a lot of work. So we've been kind of in market trying to facilitate the creation of these businesses, and we invest in them, and we take a small equity stake in these entities, but they are intended to have local management teams, local boards, like a totally independent business, and we kind of act as advisors and investors to get these off the ground, and then hopefully they buy a lot of Solana, and that of course drives demand and hopefully price appreciation, and also sort of creates local spokespeople and advocacy for Solana in that market. So that's been a big focus area for us, and we plan to continue to focus and invest in that area.
Very cool. And then finally, do you have like a target for how much Solana you want to own, say by end of year, or I don't know what time frame you'd look at?
For how much Solana we would want to own, no, but we have put out forward guidance and then reaffirmed it at the quarter, where we projected forward the annual growth on a SOL per share basis at 261%, and we have a longer term target, which I'm not reaffirming, but not reaffirming either of them. They were reaffirmed some weeks ago. I have to be careful with my public company language. To target 1 SOL per share by the end of 2028.
Okay, and then do you have a price target for SOL?
Yeah, longer term, I think market cap wise, there's not a reason that it shouldn't be a $1 trillion asset. And shorter term, like I said, I think if the cycle lasts long enough, it has potential to flip Ethereum by market cap, which I think would put Solana's price at over $1,000 today.
Wow. Okay. Bold targets. We'll see if they come true. Maybe we'll have you back on the show and see where we're at the time. But for now, thanks so much for joining me. This was super interesting, and yeah, loved learning more about what DeFi Dev is doing.
Well, thank you for having me. Appreciate it.